Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, March 9th, 2021. What we'll do in the video is follow up on the things I've been watching lately where I think opportunities are. So I'll start out pretty much a follow-up to yesterday's last video. Start out with the stock market, touch on gold, crude oil, in the energy stocks and treasury bonds. All right, starting out with the stock market, we have one of the bigger moves in a while here today in the QQQ, and I want to talk about that real quick. What it means, what it may not mean. Well, there's a big difference between an impulsive move. How does it not feel bullish when QQQ is up 3.62%? Again, one of the biggest gains, daily gains in a while. It certainly could be the start of something more. I've said it, answered in the FA or under the comments section recently. Somebody asked, I mentioned in videos. This certainly could be the end of a pullback. It was a Nasdaq hit, as called for. We hit correction mode. It was a 10% drop, and we hit that 297 second target there, and so that could certainly be the end of the correction, or it could bend the first leg or first wave down with a much bigger drop to come. And again, I gave you the parameters yesterday, or the conditions that we need to see, and that's going to be a break below that 297 support. We already hit it on Friday, and so far we're bouncing. Now, okay, so what I'm trying to get at here is there's a big difference between a big down day in a stock or the market, or a big up day like today, being either bullish or just noise, bullish, bearish, or noise. Okay, so what I mean by that is a rally back into resistance is at this point in time a non-event. In other words, a 3.62% move in QQQ certainly seems and feels bullish, but it didn't make any technical changes to the charts. All we've done right now, other than provide another objective short entry, is rally back into the bottom of the recent trading range. I'll zoom in real tight so you can see it in the video, and that's the yellow lines here. There's our recent trading range. We had 8 consecutive candles. That's about a week and a half of trading, because those are 8 days, trading days. And then you had a weekend in there where we traded between the yellow lines there. And then we broke down, back tested, offer an objective short entry on the kickback there, and again yesterday before the big drop. And now we're right back to resistance. So to keep it very simple, if we build on today's gains, it has the potential to, trigger some near-term bullish, changes in the chart. But as of now, it's just a rally back to resistance, and therefore, as it did here, and here, provides an objective short entry with a stop somewhat above. And if they take it out, again, your next resistance level, other than the midpoint of the range, minor resistance there, it's going to be the top of the trading range right there. And had QQQ been up 3.64% on a day, let's say that it broke out above a falling wedge pattern, bullish falling wedge pattern. You had a big green candle above the pattern. That would be uber bullish. You want to see a breakout confirm with above average volume and impulsive buying alongside breakouts. So that's it. I just wanted to say it is just noise within a trading range, just as each and every one of these moves here were. Keep in mind, these were about comparable moves from the bottom. There we hit the bottom of the range, went up to the top of the range the next day, then we turned around, went to the bottom of the range. So you get the drift. This is no different. We went down to that very solid support level, 297, bounced as expected, then got rejected off the top of the range, and we're bouncing once again to the top of the range. So that's it. I just wanted to say, as I said yesterday, not that this can't go any higher, but ideally, at this point in time, the only objective move or trade at this point, if there's a trade to be made, would be to close longs and or short right here at the 310-ish level. And I think that's it for the day. I've seen QQQ certainly go higher in a single day, but that's usually it. So I just want to get that out there. There's an objective short entry for you. Stop's not too far above. All depends on your target. You want to just play another move down to the bottom of the range at 297. Well, that would only be, go backwards about a 4% drop. But I think if we get even close to it again, based on where we are in things, I think we'll go down on through there. So I'd be more apt to set a stop and let it ride if that is your plan, unless you're day trading. And if you're day trading, there's a day trading op, excuse me, bit of a tongue twister, to be made. And that's just a fade of the rally right there. Short at today's right where we are right now, about that 310 level, 310.85 right now, 86. And then something else to note, and this is really to be expected. If you look at the size of these candles right here, these big, all these candles, or if you look at the smaller candles, look where we closed one day, then where we went the next day because there was a gap. So gaps don't show, but that's there's a move from there to there within a day. Sometimes you have that top to the bottom of the range within a single day, just as you did here the other day. But and these are much smaller candles. Now that can be reflected in an indicator called the ATR. ATR is the average true range. I've set mine for a 7-day period, so it takes the range of the security you're looking at, in this case QQQ. And what you'll notice here is uh, these spikes in the ATR, again over that period, they come during periods of corrections. And what you have is, low volatility, and all of a sudden volatility starts to expand. The daily range, these price swings, and that's what you had. So let's just examine that drop, that big drop down into the March lows of last year. In the beginning, you had a clear rise in the ATR, right about to where we're at now. Let me put a line there for you. So here's where we are today. Let me show you what I'm looking at. There's where we are today. We came off from lower volatility. Volatility's been spiking just like it was here, about the same exact level. And right there we hit it. And what happened is it abated. We had the initial leg down, then a counter trend rally right there, and then we popped that level. And so this is pretty much capped. We've had a couple corrections along the way where that level is roughly capped. But so that's it. We're probably either going to, the correction's either over, and volatility will begin to abate if we start to climb up. In other words, you probably won't see many 3.5%, 4% days going forward, and you'll see the ATR drop off, or we're going to get rejected soon, take another leg down, and then the ATR is likely to spike. So that's one thing to look for. And I just wanted to say again, this ATR tells you right now that big daily price swings are the norm. So don't read too much into it unless it does something, a technical change. In other words, a breakdown. You see a big drop below 297 on big volume, or a big impulsive drop down, 3-4%, then that is technically significant. A solid move, like I said before, there's a lot of overhead resistance, so just taking out the bottom of the trading range to me doesn't mean off to the races, markets going to new highs. It is resistance, but it's one of several resistance levels, as I mentioned, including the midpoint of the range. And so that's it. That's what I said a few days ago. The Nasdaq has some tough sledding overhead. Quite a bit of resistance to get through now that, especially after the breakdown, that we've consolidated and we put so many reactions in to set those levels as resistance. In other words, they weren't really much of resistance before, and now they are. Okay, hopefully that makes sense. And again, maybe the correction's over. I can tell you, the Nasdaq was getting way oversold. A lot of stocks at support. I'll go over those in a second. And so now what we're needing to see is the S&P. What's the S&P going to do from here? We're going to start to see some of the sectors roll over. Today it's certainly a rotation back into the beat down tech sector, and that was going to come sooner or later with tech beat down and many of those names at support, as I just covered the other day. So we'll keep an eye on the S&P 500. It'd be healthy to see, continued positive breath, meaning the majority of sectors up. But so far today, we're seeing the financials down and energy. Those were the two of the ones I was looking at. And so far that we're seeing profit taken there. And again, it may be just a short-term rotation, people booking profits in financials. Not a bad idea. I certainly would have, had I been long financials up until yesterday or the other day when a lot of tech stocks hit support and have had 10+% corrections. Absolutely, it makes sense to start rotating into that out of the tech financials. But just to wrap it up here on the S&P, we're right back to that 387 or 388-ish resistance right there. And again, so both the S&P 500 and the Nasdaq 100 are still in near-term downtrends. Nothing's changed technically, is what I'm trying to say. And here's the S&P up 1.72%. There's the ATR down there on the bottom. You can see average true range. And again, this is about where it gets to during these corrections, and then once the correction's over, you'll see the volatility start to abate. However, if you pop much higher, that's what you'll see: bigger down days, and it meshes with what I'm saying. If we're going to undercut those lows and have another wave down, which I still lean towards, despite the markets being up as much as they are today, then that's probably how it's going to look. You're going to see even bigger drops. 3% plus down days will be the norm soon, instead of outliers. Okay, so enough on the equity markets. We'll now go to look at. Oh, by the way, here's NQ. I said enough on the equity markets, but I just wanted to hit on the futures. Remember, this was a target support zone right here, right? We had a lot of reactions there. Boom, NQ's rallied back into there, and again, just like QQQ, that's the same. That's the comparable resistance. QQQ has been bouncing. There's that. It was support here, and we broke it. Back test, back test, back test. So again, I'll say it one last time. Objective short entry here, whether you want to fade the rally as a day trade, or maybe trail it down, ride it into the close, or short it, set a stop and forget it. Have a stop above the highs and or trail it down for a potentially much larger move. So that's my thoughts on the equity markets. As I said yesterday, I had what I call a hard buy on gold instead of scaling in. I think it's time for long-term traders, at least it looks objective, to start buying gold and gold mining stocks. And that was based on, well, I did plenty of analysis on it yesterday, so I'm not going to get into it. I'll just do an update there. Look, and that's what you want to see. You want to see an impulsive buying off support. It doesn't guarantee we're going to go up and start the next wave up to new highs or hit those nearer term targets. I gave you targets on GC, and I'll try to give you some comparable targets on GLD soon. We were down here, so far it's about a good 2% rally from where it was in the video. And remember, this is a 60-minute chart of GC gold futures. You don't see the support here. The support was based on the much more significant daily and even weekly time frame. So that was your objective buy entry there, or objective buy level, with the buy signal, or the next objective level to come on a breakout above the bullish falling wedge, which we got this morning, and then again on that 1707-ish level just above, and we're only a hair above it now. We're at 1710, so and there's a reaction there. So a little more work, but I like it so far. So unless this fails, it is a breakout, and unless that fails, and if it does, well, what does it do? Do we come and back test the trend line? That might offer another objective entry, because remember, don't forget, down here is big support on the daily chart. So I'm fine if the futures want to do this. I'm even fine if they have a quick washout move, shake out the last of the weak-handed longs, suck in a few more shorts. So again, my view is I'm treating this as a either both a swing trade, multi-week swing trade, as well as a potential trend trade, which is multi-month, 6+ months, if this is the end of the correction in the bull market in gold that started a few months back. Okay, so again, on the 60-minute chart, that's what I like to see. Love seeing positive divergences, trendline breaks, impulsive action, everything there so far. Doesn't guarantee it plays out, but it's looking good so far. And of course, I'll go back to gold here. If I can find my charts somewhere, there it is. Gold 60-minute. I'm gonna have to work on this. I gave you this chart yesterday. It has some old levels. I'll have to sharpen my pencil and identify. I can tell you right now, minimum target right here about 165.90 right there. Pretty good resistance. So if you're just looking for a near-term target to play a bounce, that would be it. And again, if you're longer term, and you got a good entry yesterday or even today, I like to buy at support, but even today you can just set a stop somewhat below yesterday's lows and let it run. And then of course you have GDX, a gold mining stock, 60-minute chart. There's a daily chart, which I covered yesterday. There's a move, so up about 3%. So look at that as a hedge, to any equity shorts. If you're swing short, these GDX is up as much as QQQ, so that would be a wash there if you took GDX yesterday. And the other risk-off assets, which I said I liked yesterday, are Treasuries, TLT. Really, I like the 60-minute chart of ZB, the Treasury bond futures, long bond, and so far, nice. There's a breakout. So there was our downtrend line. There was our breakout pointed out a couple weeks ago, and then as mentioned yesterday, what we didn't have on the breakout a couple weeks ago was divergence. So we back tested, and then put in negative divergence. Finally took out that minor parallel trend line, and that gives us a buy signal on ZB. So uh, I did say that the gold and treasury bond trades, it would certainly help to see the stock market correct and give those flight to safety assets a bid, both treasury bonds and gold. But it is not completely exclusive on that. There are plenty of times that gold and treasury bonds rally in line with the stock market. So, I like these for two reasons. This is both pure plays, meaning, in other words, long treasury bonds, long gold right now, and as swing positions and short the equity markets. So these charts can play out. Maybe the equity markets rally and these still play out, in which case they'd be a hedge. It's a way to diversify. These are completely different asset classes. Asset classes are stocks are one asset class, equities, of course. Bonds are another asset class. Commodities are an asset class. Gold, precious metals, you can lump it in commodities or have it be its own asset class. I consider it as such, especially when looking for, potential flight to safety rallies and things like that, etc. So again, that's to me the most important part of trading and investing is, here's your portfolio, whether you're a long-term investor or an active swing trader, but that portfolio should have different pieces of the pie. It might be whatever your number is, equities or commodities, and or a combination of above, precious metals, gold, silver, and the miners. And over time, this number will change, and over time, you might not have any of these, or you might be short equities, net short or fully short, or long equities, and it all changes. And then within the equities, you have subdivide that pie down by sectors. What are your most bullish sectors and most bearish sectors? So quite often, I'm not, if I'm short or long, I'll refer to being net short the market or net long the market, because I might be long energy stocks at that time while short, financials at the same point in time. So again, and that would then all fall under the equity exposure. Okay, and didn't mean to go off on too far of a tangent, just trying to impress the importance, and that's why I cover many different asset classes. One day you're going to hear me talking day after day, week after week about Bitcoin and Riot and all these cryptos. Then I go silent for a while, and that's because I just don't see a lot there. I'm not trading them. There's not a lot in the charts that are telling me clearly it's going to go one way or the other. So hit and run, get in and out of that sector, and then move on to the next one. Then for a while there, it's gold mining stocks, silver, wheat, corn, soybeans, you name it. And so I don't always have exposure to each and every sector, but when I do, I like to include as many as possible. And if you've done this for a while, you know why. It's going to smooth out the bumps. The day that you're long energy stocks and they go against you, and you're short the financials, or you're long corn and wheat and all that, they're going to offset the losses and help smooth out the bumps, so you don't have those big drawdowns. Okay, and to wrap the video up, what I meant to do when I covered the equity markets, all right, is cover those long trade ideas I threw out the other day as both hedging and or pure plays. And this was a list of those stocks posted. First covered in video, I think it was on Thursday, followed up on Friday morning. And that was we had Tesla, Amazon, Microsoft, Home Depot, Walmart, and Johnson Johnson. Yeah, obviously all doing well today, but here's what I wanted to talk about. So Amazon, for example, was a play off support 29.43. Big market leading, beloved stock, great company. and hit support, and so far rising and holding that support. Microsoft, same thing, was a pullback, long trade idea on a pullback to the top of the recent trading range at 228.16, doing well. Home Depot also off the 247.12 support, but ran up. That one's hit this resistance level. It's a hair above it now, but this is another reason. This is what I wanted to talk about. A couple of these trades. If you're an active trader and you just wanted to play the bounce, I would put good odds that Home Depot will stall out here, at least consolidate, even if it's going up there. No guarantees. Now you can trade this one of many ways. You can take quick profits, get out. If you bought it at 247, and right now, so far it's rallied about 7%. You made 7% in a couple days. Take the money and run. That's option number one. If you're a longer term bullish or not sure what to do, want to maybe stay in this in case it's going to continue on and go to break out the new highs and beyond, just trail your stops up. At the very least, if you took it down around 247, you should raise stops to at least break even. That way you don't lose anything. Initially, when you took it, you should add a stop a little below. Trailing stops are nice too. You can use 2, 3, 4, 5, 6%. The wider your trailing stop is, the less likely you are to get shaken out on the pullbacks along the way. So that's it. Now, as an active trader, and based on what I just said with the stock market at resistance, I think is a good time to take profits, and you can even reverse and probably get a short pullback trade on it, because that's pretty big resistance right there, and we're just getting a hair above it. A lot of momentum carrying the market up this morning with the Qs up nice, but that's one of them I just wanted to update. And the other ones, Walmart, that was off the 128 support, not really taken off yet. Now, and again, I'm going to show you glass half empty, glass half full. Glass half full holds support, it rallies. Glass half empty says this was an impulsive move down right here. See this leg down from this? We had a gap and impulsive move. This is potential bear flagging action. And where better for a stock to consolidate? A bear flag, by definition, you follow an impulsive move down, which is called the flagpole, set up a level of consolidation. Volume's a little high. You really want to see decreased volume, so I'm going to put a question mark for a bear flag, but it's taken the form. Now, should the market take another leg down and Walmart break that support, then that would break down from the bear flag, and the measured target is the top of the flag. You had the flag pull onto there. It would take us down to that next potential target there, all the way around 115. But again, I highlighted it as a long, either a pure play, beat down, world's largest retailer, and you can make a case to step in there with a stop just below the recent lows and let it run. The other ones are J&J. That was off the 154 support. When I highlighted them on Thursday, that was last Thursday, was right here, they had all just slightly undercut, and I said that's fine. We had a lot of momentum going down, the market was selling off, but it's on Johnson & Johnson. I said this is solid support, and so that's perfectly normal to see what I call a momentum fueled overshoot, and in fact give you a better entry price, and so far moving up. So check, but now there's one more I wanted to cover, and then I'll wrap the video. Tesla up 11.5%. You're like, wow, if you haven't traded Tesla, you're probably like, wow, almost 12% in one day. But again, just as I started the video, from a technical perspective, as bullish as a 12% rally in a single day might sound, it not only doesn't change anything in the technicals, it actually offers another objective short entry. And that is because Tesla, as mentioned, back here had it as a breakdown, short entry, with the next signal to come under a break above 800. We got it there, so that drop was called down to this target here, 661.78, and or I said the trend line, which is just below. They came in close proximity. They hit that target, bounced for a little while on the 661.78 support, then went on to hit and then broke my trend line. So we broke it, and that support broken. We back tested the other day, and we're back testing again. And on top of that, you have dual resistance levels just above. If it happens to regain this trend line, you have 661, again, call it 662, round it off, and the downtrend line. So as big as this move is today in Tesla, all it's doing is back testing resistance, the broken trend line, And if it happens to regain that, then it has 2 additional resistance levels above. So here's another example of a stock that might seem uber bullish today, but offers an objective short entry with a stop somewhat above. And again, so if you're wrong, or if I'm wrong, and I know I'm not wrong on saying it offers an objective short entry, but I do believe it'll be rejected soon here. So what I'm getting at is, if you shorted Tesla right now, you have about, I'm trying to measure it here, about 4% or so upside to that target. So you give it a little room to pop it intraday to have a little stop clearing move. So say 4% is the resistance, that downtrend line. Give it a stop based on a 6% daily close above where we're at right now. So you're risking 6% to make, potentially, if my next target is hit, grab down here, that would be 26.5% drop. So I'll take that all day long, risk 6% to make 26%. So there it is. I just wanted to mention that, there is a difference in this. We may build on these gains, and if that's the case, if we continue to build on today's gains, and Tesla takes out resistance, and some of these others that I've mentioned that recently broke down regain those breakdown levels or take out resistance, then yeah, that's bullish, near-term bullish, and Tesla will probably come on back up, and then the next resistance at that point is 802. So you can look at this two ways. If you're bullish and you took or you plan on taking Tesla, just set your stops, and there's your next target, about 800, 802. And if it takes that out, it's pretty much smooth sailing. There's not much between that and the highs. But I favor this. I think Tesla topped here. I think that was a major top. Although the stock has already dropped from that point about 30-40%, I have more downside. I think before all said and done, I think at minimum we'll come and hit my 65-ish target there, and possibly quite a bit more. These are all potential downside targets on Tesla, and that's it. Let's just see where we go from here. I'm going to wrap it up, get the video out to you guys, and let me just think if there's anything else that stands out. Hold on one sec. No, that's it. I'm looking over various commodities, various charts. I mean, there's other things out there, but these let's just focus on these that I'm looked at now. Oh, crude, that's it. Yeah, I meant to. I told you I would update crude. There's crude, kind of flirting with that trend line. It's been moved through a few times, but as I mentioned yesterday, we had this momentum fueled wedge overshoot right there. Move back down. Crude's creeping a little lower, and the energy stocks are down, and XLF so far has been rejected where it should have been. I'm sorry, XLE, excuse me. XLE, that's the energy sector ETF. Big resistance in my book at 53.61. That's major resistance, and we rallied into it. And again, nothing big, but look at this. If we go much lower, we're going to crack this uptrend line, and that gives you a sell signal that should take you back to at least the $47 level, if not more, and then that should carry over into XOP and things like that as well. XOP has a comparable trend line right there, similar technicals, and XES is the other energy sector ETF, and that's also a big resistance right here. And that big resistance, this was key support for months until this breakdown that led to that meltdown into the March lows. So that's a very technically significant level, and that's XLE rallied into that comparable level, and as has XES. So therefore, I like this is one of my preferred sectors to be short. So to summarize the video, short crude oil and the energy stocks. So crude, CL are the futures. These three ETFs, any or you get more bang for your buck shorting XCS or XOP than you do XLE normally. And you can buy DRIP, DRIP, which is the inverse, two-time inverse of XOP, long or bullish gold, and the gold mining stocks and things like that. Bullish treasuries right now, and bearish equities at this point in time. And that can change soon, but still think it's an objective entry. So I think that covers everything. And let me wrap it up here and get the video out to you guys.